11 a.m., so I'm a little bit late. Sorry. This is going to be auditing. We're going to discuss Chapter 9. Well, I'm going to discuss Chapter 9 very briefly. I'm going to try to be briefer. I always say it would be brief, and it never ends up as brief as I want it to be, so I'm going to try to be quick today. I do want to start off with a message from Margaret Skipworth. She's in England. And it's actually funny. When you read it, when you hear it, you're going to realize this has got a whole lot of economics in it. Some tin stoffel, if you know what I'm talking about. There's no such thing as a free lunch. So here is the message from Margaret. As soon as I was old enough, I applied for a senior bus pass. This allowed me to travel on buses free at certain times of the day. It's great. I told a friend one day when we met for lunch, sitting on a bus is much more restful than driving. I can look out the window and enjoy the scenery. I've been to places I wouldn't have been able to afford to visit if I had to pay the fare. It is all free. And not really, my friend replied. Someone has to pay for it. Everyone who pays taxes to the government is contributing toward your free trips. There's the tin stoffel, right? Now, put in the context of Christianity, my friend's words made me think about our faith journey. As Christians, our destination is heaven, where we will be with God for eternity. Our journey might be difficult at times, but we can rejoice that the fare to get us there was already paid when Jesus died for us on the cross. Isn't that great? It's very good. A message regarding Easter's getting close. I think it's just a great message for today, right? So our fare has been paid, which is great. So chapter 9, it deals with the production cycle. And you can kind of see that here on the screen, okay? This little chart right here kind of shows you where it's fit in the this little cycle, if you want to call it that. So the production cycle, it does involve inventory, and the production cycle will be still a thing, even if you're not a manufacturer, even if you're just a retailer. Now it might be a little bit different, it might be a little more of an acquisition, but there still is an inventory to deal with, and an inventory can be a very important part of the auditing process. So when we think about chapter 9, let's try to think about it in terms of that we are we are auditing a manufacturing public company that does manufacturing. They manufacture the goods that they're going to sell. So the acquisition cycle, making those purchases, they're purchasing essentially raw materials. Through the production cycle, we're going to turn those raw materials into finished goods, and we all know that the middleman there is work in progress. Okay, so we're talking about some cost accounting there as well, and even like allocating overhead. But once we get those finished goods inventory, then we can start making our sales, start removing stuff out of inventory, applying the cost of goods sold, and then down here you've got your payroll. Okay, well, payroll is important because you got to pay the people that are manufacturing those items, manufacturing the items that you're selling for a profit to make your business work, okay? You can review this flow chart here later. It's a little more in detail, obviously. And it's got two of our important documents in here. The first one being the sales forecast, and then also the production plan. And it says right here, and I can even highlight some of this. Oh man, let's get the period in there too. There we go. So, reading this sentence here, production activities start with the sales forecast. So we got to rely on those stinky marketers or that marketing department to come up with sales forecasts. A marketing projection of product sales based on past performance and marketing incentives. Obviously, we're going to look at last year's and the previous years. We can do, going backwards, we can do a lot of stuff like trend analysis. At least the management of the company can. And then also, marketing is going to try to, the job of the marketing would be to increase sales as we go forward. So once the marketing has, we have a sales forecast. Based off of that sales forecast, um, management can come up with a production plan, right? And so the production plan is down here. The goal of production planning is to provide a schedule for manufacturing so that quality products will be available at the appropriate time for the lowest cost. Um, so we want to have a good handle, or again, this is management. Management should want to have a good handle on the production process. We want to be making product to be ready to be sold at the appropriate time, and also if we can avoid, if you have to make more than necessary, or if there's a big spike in demand, that means you're going to have to go into paying overtime, which is going to increase the cost of the products you're making. And if we want that lowest cost, then if we have overtime involved, then not necessarily what management might want, right? So the production plan is going to, essentially tell, whoever's in charge of manufacturing how much to make and when, and how many hours is scheduled to get all this stuff ready to be available at the right time to be sold. I remember this JIT stuff back in my college, just in time. We wanted to have the goods to be ready just at the right time to be put on the truck to be shipped off. The less you could have in inventory, the better. I do remember some of that from back in the day. And it was, back then it was kind of we want to do this just-in-time stuff, but we really can't because we don't have the logistics. We don't have the big word they hear nowadays is the supply chain, right? We don't have the supply chain to do it. But now people do, and so this might be something you'll see more and more in some management classes, is just in time. Okay, so let's talk about our first question of the week, which is in Blackboard. The question is, what are the high-risk assertions for inventory? Okay, and you can see them here on the screen. Here's inventory. The three with high risk are existence, valuation allocation, and cutoff. So that's going to be your question for question number 1 for chapter 8. Now, the second question I'll put up, I'll actually ask you a separate question that might take a very minor amount of research. So that'll be up a little bit later today or tomorrow for you to do. But anyway, so remember our question number 1 for the week is, what are the 3 high risk assertions for inventory? Here they are: existence, valuation and allocation, and cutoff. Okay. Now, the first thing we come to in this book, or in the chapter here, is going to talk about controls. Okay. So as the auditors, we have to do the internal control audit as well as the financial statement audit. So some of it is, so when you look at this page here, and I suggest you read the entirety of what is called the internal control activities and design evaluation, which is on, page 405. Learning objective 9.4, identify the important control activities present in a properly designed system to mitigate the risk of material misstatement. Excuse me. Sorry about that. So, here, this paragraph right here has a lot of good information, and then it goes directly into a list of some other things that we would want to look for. So this, under control considerations, this paragraph here, and then these bullet points is just some wonderful information that you need to review. Let's look at this paragraph up here. Control activities for proper separations of responsibilities should be in place and operating. So the big thing here is separation of responsibilities, and it should make a fair amount of sense. By referring to, here's an exhibit. Where's that exhibit 9.2 at? I didn't even look at it. Oh, it's back. Well, we won't worry about that. You can see the proper separation involves authorization, production planning, inventory planning, and purchase requisition by persons who do not have custody, record keeping, cost accounting, or reconciliation duties. Okay, custody of inventories, That's who's in charge of the three different types of inventory there: raw materials, work in process, and finished goods. Is in the hands of persons who do not authorize the amount or timing of production or the purchase of materials and labor, perform the cost accounting records. Okay, you see kind of where this is going. Persons do not authorize production or have custody of assets in production process, blah, blah, blah. Now, it's very simple, right? So we've talked about this in other accounting classes. The person that's in charge of inventory shouldn't be a person that's able to remove stuff from inventory, because why? Well, they could steal it, remove it. So simple. Some of it's as simple as that. Now, it could be a little bit more. You don't want the person in charge of inventory to be planning overtime for his buddies, and then they're overproducing as well because his buddy needs extra money to make payments for a jet ski. Who knows? So you get an idea what I'm talking about. You want to have separate people along the way, and then the only way there's possibility of fraud would be if there's collusion, and of course, collusion always will defeat internal controls. Anyway, there's more down here. Let's read one or two of these. Here's a short one. Some other control activities. Materials should not be issued to the production floor without authorized material requisition. That makes sense. What's this one down here? The production supervisor and finished goods inventory custodian should review production reports of finished units and forward them to cost accounting. Okay, so just some good control activities in place. Read those bullet points. Maybe reread that paragraph, and you'll be in a good spot. Okay, so that's the internal control considerations. There's some questions here. What can go wrong? Okay, these are always good to look at. This is the next page. When you're testing these controls, what does this say? Cost accounting is separated from production, payroll, inventory control. That's a good thing. How do we test it? By observing the separation. Okay, observation. Remember, when you test controls, there's only four right there, four possible ways you do it. See if I can remember these. Inquiry, observation, documentary evidence, and what's the last one? Recalculation, reperformance, one of those two. Okay? So read through, kind of look at these, what can go wrongs. Be a good place to look as well. Read through it one good time. And let's move on to what, as auditors, we do for the audit of the inventory for the financial statements, okay? Excuse me. Remember our three exertions. Hang on, I got a cough. There we go. I spared you your eardrums. There's three primary assertions: existence, evaluation, allocation, cutoff. Right. So, this is not where I want to be. Let's see. Here we go. Here's our biggest thing here. Okay. The biggest thing that we want to do in the audit of inventory is physical inventory observation. Now, it does say the word observation, not physical inventory checking, okay? Or we don't do it, okay? The auditors don't need to be counting the widgets. Now, I have done some counting of widgets back in my day, but for the most part, you're there to observe employees counting inventory and maybe do a few test counts, or watch closely a few counts and then make sure that those agree to the inventory records, which there is also posted within the inventory number on the balance sheet. Let's read this paragraph. The auditing procedures for inventory and related cost of sales accounts frequently are extensive in an audit engagement. Okay, the procedures for inventory and the cost of sales accounts are extensive in an audit engagement. Remember, a material error or fraud in inventory has a pervasive effect on financial statements. Although analytical procedures may indicate inventory misstatements, the auditor's best opportunity to detect inventory errors and frauds is during a physical inventory observation. An observation of the client's physical inventory count taken by company personnel. Auditors observe the inventory taking and make test counts, but they seldom actually count the entire inventory. Okay? We're going to watch some people count inventory. We'll double check some of their numbers. If we see no problems, then we assume the rest of it is fine too. Okay, remember, reasonable assurance. So down here below that, what I highlighted on my sheet here, this is what substantive analytical procedures and tests of details. Okay, scroll down on that tab. You see here physical inventory observation. That's what I just read to you. And then if we come down here, you've got these 11 things. Okay, auditor's first task to review the client's inventory taking instructions, which should include the following. Okay, so these are the instructions for that inventory. Okay, so names of the client, client personnel responsible for the count, dates and times of inventory taken. It should be right at year end. Okay. Names of client personnel who will participate in the inventory taking, instructions for recording accurate descriptions of inventory items, for counting and double counting, and for measuring physical quantities. What's down here towards the bottom? Instructions for making changes and corrections to ticket counts. So review these 11 bullet points, but these are all important considerations that you would want to be familiar with before you observe that inventory inventory taking procedure. Okay, and here you see this here. This is, nowadays we use these things. They go a little bit quicker, little barcode scanners. All right, so there is a little bit of other wording in here about here. Just talk towards the bottom. Inventory is located off the client's premises. So we want to determine when and where. Okay, so sometimes they may have some stuff out on consignment. However, what does it say up here? Auditors should have sufficient appropriate evidence for the physical quantities and valuations. Here we go. Consignment goods. We want to make sure those are included in inventory compilation. It may be hard to count those ones that are on a consignment. I've never really heard of confirming inventory on consignment, but you could potentially do something like that. You might, confirm with the consignee and see if that they have it, and they still have it. Also, goods in transit. Remember, if we're doing stuff if we're selling FOB destination, then while those goods are on that transit or in transit or with that common carrier, then those need to be included in inventory as well, because custody doesn't change until they're delivered, right? So there's that. All right. So essentially, I just did a little skim of the chapter. I would recommend you go through and do it for read it a second time. Do Learn Smart. You have to anyway, and so that'll help reinforce. Let's do a few of these questions at the end of the chapter. I think there's about 8 of them, 7 or 8. Make them visible so you can do them with me. If you would like, go to Student View. All right. Chapter 9, end of chapter questions, EOC, right? Okay, let's look at these. All right, so here we go. This is that first picture, right? Which cycle is not directly linked to the production cycle? Okay, directly linked. And if you remember that first, this first thing here, let me see if I can get back to it. It's right here, right? This is the answer. Here's the production cycle. What's linked to it? Acquisition, revenue, and then like your accounting and payroll. Okay, so let's go back and look at the answers. So here's revenue and collection. Here's the payroll cycle. Here is acquisition and expenditures. So I didn't give you time to look at the answer, but obviously the answer here is the finance and investment cycle, which is actually next chapter, and we'll look at it. We'll look at that next week. Okay, so there's that first answer. So number 2 is to determine the client's planned amount and timing of production of a product. The auditor reviews the blank. Okay, so it's one of these 4. Okay. Now, looking at these answers, inventory reports and purchases journals seems like they got nothing to do with it. Okay, so I can throw out the 1 and 3 immediately. That's going to leave me with sales forecast and production planning. Okay, so remember, sales forecast is done by the marketing department. Okay, and from that sales forecast, we'll come up with a production plan. And the production plan is what tells us the amount and timing of production of product. So our correct answer there is the production plan. So the production plan is based on the sales forecasts, but it's its own thing, and that's the correct answer. Okay. An auditor reviews job cost sheets to test which transaction assertion. Okay. Well, let's think about our 3 primary assertions first. Okay, that's also our question for the week. So our 3 primary assertions, if I'm not mistaken, I might go look at them in a minute too. Existence, valuation, and accuracy, and then what's the last one? Cutoff, right? So let's go look and make sure I didn't make a mistake there. Yeah. Excuse me. So it's probably going to be one of these 3 answers. But let's go back to it and look. Okay, well, there's only one of these on here, which is accuracy, which is probably right. Well, occurrence deals with income statement items. Even though existence goes with it, just listed by itself, it would not be a reasonable answer. Classification usually deals with, putting expenses in the wrong accounts. Sometimes that can be, putting expenses in asset accounts, which is bad. Okay, go look at WorldCom. So completeness is on the list. It's at the very bottom. It's low. Okay, but think about what we're doing. We're looking at job cost sheets. So we want to make sure we're kind of reviewing the cost accounting, which if that makes actually good sense, that's probably trying to make sure that the cost of goods is accurate, right? So accuracy would be the best answer. And then it's all it says down here. Actually, the job cost sheets indicate costs used in determining the accuracy of inventory produced. Okay. Number 4. Which of the following is an internal control weakness for a company whose inventory supplies consist of a large number of individual items? Okay. If you remember the first thing that we read, that paragraph under internal control activities, it was all harping about separation of duties. So maybe we'll see that in an answer. So let's have a look. The warehouse manager is responsible for the maintenance of perpetual inventory records. Well, that there sounds really bad. Okay, the guy who's in charge of the goods should not be able to, maintain the inventory records. Let's see what's left. Supplies of relative little value are expensed when purchased. That's kind of reasonable. If you buy a pack of pens, do you really got to put it into office supplies, or you just put it to expense, right? Perpetual inventory records are maintained only for items of significant value. Excuse me, I keep coughing. I think it's the pollen getting me. Definitely no COVID. I'm good. So this one right here, the perpetual inventory records are maintained only for items of significant value. That's bad because the aggregate of all these small items probably will be significant. Okay, and therefore it's important to do it with all the small ones too. Down here is the cycle basis is used for physical counts. This is discussed in the book. Sometimes because of the nature of the business, they need to have their physical counts at the end of the season, which it makes sense for manufacturing at where my dad used to work, which was the manufacturer riding lawnmowers. Well, about late September, the grass stopped growing. So that's kind of when it was the best time to do their inventory counts, because at that point they weren't making any more sales until really next March when the grass started growing again. So sometimes that can be appropriate. Typically you still like that end of the year. But anyways, our best answer here is number 1, the separation of duties. and proper combination of inventory custody and record keeping responsibilities. That was that paragraph that we read. Number 5, which of the following procedures would best prevent or detect the theft of valuable items from an inventory that consists of hundreds of different items selling for $1 to $10 and a few items selling for hundreds of dollars? So you've got a bunch of really small inventory, small dollar inventory items, a very large amount of them, and then you've got a few items that are very, very valuable. Okay. So one of the best ways, and I haven't looked at the answers yet, but the probably the best way to do that would be to separate out those expensive items into their own either location or section of the warehouse that's more guarded than the rest. So let's see what we got. Here you go. Have a separate warehouse space for the more valuable items with frequent periodic physical counts and comparison to perpetual inventory records. That's almost just what I said for the most part, right? So that sounds really strong. Number 2, have an independent accounting firm prepare an internal control report on the effectiveness of controls over inventory. Well, we're going to do that, so why would we hire somebody else? That's our job, right? Number 3, maintain a perpetual inventory of only the more valuable items with frequent periodic verification of the accuracy of the perpetual inventory record. Well, we don't want to ignore the lower dollar stuff, because if there's a ton of it or a whole lot of it, then it's still going to be an aggregate material and therefore important for us to keep an eye on. Down here, require a management signature for the removal of any inventory item with a value of more than $50. It's probably just good practice anyway. But the best answer here by far is to have it in its own special area. More frequent counts. Okay. Number 5. It says separate space facilitates security. Okay, maybe it's just a fenced-in area inside of the warehouse, that only certain people have the key to. It doesn't have to be a totally separate location across town or across the county or across the state. All right. From an auditor's point of view, inventory counts are more acceptable prior to year end. So it's always the best inventory counts that you're going to get are right at year end. Okay. In some places or some audits, if it's material and you're not allowed or you're not able to observe inventory, you may not be able to give an opinion. You may have to give that disclaimer of opinion because you were not able to observe the inventory count. This is a constant problem whenever a auditor comes in after year end. Well, the time for that count has come and gone. You missed it. So there's always an issue then. So we're looking for when it's more acceptable to count prior to year end. Okay. Inventory is slow moving. Okay, that's you probably don't need too many counts. Just do one at the end, and probably would be good. Okay, so it'd probably be more likely to have that year end if it's slower moving. Number 2, significant amounts of inventory are held on a consignment basis. Now, this could be difficult to audit, but it still would be a good idea to do it at year end. Accurate, perpetual inventory records are maintained. This is probably going to be the best answer, especially looking down here. If internal control is weak, then you almost have no choice but to have a year-end after year-end or at year-end inventory count observation. So the best answer here is accurate perpetual inventory records are maintained. That means they're on top of inventory at all times, and we might could accept a prior to year-end observation. And there is no answer from the book. All right. Number 7, almost done here. Which of the following internal control activities is most likely addresses the completeness assertion for inventory? Okay. Which of the following internal control activities addresses the completeness assertion? Remember, completeness is low on the list. Okay, so completeness is low on the list. And whenever I think about, and I'm trying to look at the answers because I don't want to give it away. Whenever I think about completeness. Remember, we're starting at the source documents and we're going forward to the posting in the inventory records. So the best thing you want to see there, because you want to make sure nothing's left out, would be pre-numbered documents or pre-numbered work orders, pre-numbered production, orders to produce stuff. So what we got here? Receiving reports are pre-numbered, and the numbering sequence is checked periodically. That's what I said. Now, what's a receiving report? Let's see. When they're receiving, I guess when they're receiving, I'm not sure what it means by a receiving report, but obviously pre-numbered documents is good. Let's see what's left. The work in process account is periodically reconciled with subsidiary inventory records. Employees responsible for the custody of finished goods do not perform the receiving function. Okay. The separation of this, there is a separation of duties between the payroll department and inventory accounting personnel. That sounds good. Which of the following inventory control activities most likely addresses the completeness of search for inventory? So I guess if we're receiving the finished goods from manufacturing, we would want to see pre-numbered documents. So if the warehouse is receiving finished goods, this is probably your best answer. We got that pre-numbered in there, which is what I wanted to see anyway. Checking the number sequence on pre-numbered receiving point reports is a way to detect omission. The recording of inventory received. So there you go. An auditor would vouch inventory on the inventory status report to the vendor's invoice to obtain evidence concerning management's balance sheet assertions about what? When I see vouch, we should all be thinking existence. Okay? I want to hit it. I want to hit it. Okay? However, I actually did some. I had to look into it before I chose it to make sure. And so for the existence, it would not be looking at the vendor's invoice. Okay? Instead, we would want to look at the receiving report from the previous thing, right? So when actually it was received in the inventory, that would be existence. If we are vouching to the receiving report, yes, existence. But here, we're going back to the vendor's invoice to get pricing information of what we paid for this item. So we're not doing existence with this vouching, we are actually doing valuation. Okay, and that's a very tricky question. That's why I wanted to include it as well, because it's tricky. And what does it say down here? Okay, and this is why I wanted to make sure I include it here. Look at what the book says too. The first inclination is to choose existence because you see that word vouch, because the auditor is vouching. And vouching usually implies a test for existence. However, in this case, a vendor invoice would provide evidence about the amount that is being billed, which is valuation, but would not provide information regarding the fact that the goods were received and appropriately included in the inventory status report. Vouching for existence and tracing for completeness are good guidelines, but should not replace the student's thought process on what evidence is being gathered. So, tricky question that they put in there, and I wanted to make sure I included it. You've got a good explanation, right? So there's the explanation down at the bottom. All right, guys. I'm getting ready to cut this off. I'm going to prepare the Chapter 9 quiz, and I'll get that up probably within the next hour or two. Make sure you remember the question on Blackboard, get that typed in, and I will be back probably next Tuesday for Chapter 9. This is Chapter 9, Chapter 10, okay? There will be a second Blackboard question on the discussion board that will require a little bit of research, but I'm going to try to keep it very simplistic as we're going through this crazy time, right? So make sure you're doing what you need to do, your physical distancing. I think they're trying to change it from social distancing to physical distancing, whatever. Remember, the time that you're staying at home is time that you're protecting your loved ones from the possible transmission, I guess. And so, wash them hands, don't touch your face. Read your accounting textbook. Do the Learn Smart. Do the Chapter 9 quiz when I get it up there. God bless you. We will see you next Tuesday, if not before, for Chapter 10, which is the investment cycle, okay? Financing, and I think it's financing. Investment cycle? Well, whatever it is. We'll see it next Tuesday. See you then.